Hello, everybody. This is Andy Lebow of Commodity Research Group. Today, I'm joined by Marty Stetzer of EKT Interactive and also with Ed Meir from Commodity Research Group, one of my colleagues. And today, we're going to be talking about oil and metals, two very interesting topics to discuss. Marty, good morning.
Good morning. Nice to hear your voice again, Andy. Look forward to your comments.
Likewise. Well, let's start out with crude oil, since it is clearly front and center in a lot of the trade and certainly in the media and the way it's moving. Undoubtedly, there are a lot of cross currents in this commodity, and we'll talk about as much as we can of what we're seeing. But obviously, the number one factor right now is geopolitical risk. The market has, at least for WTI, after coming off from $66.60 down to $50, has held and rallied sharply, given what's going on in the Persian Gulf. And as our listeners know, there has been military activity, and there was almost a widening of military activity overnight. Today, incidentally, we're recording this is June 21st, so the U.S. almost attacked Iran on a limited basis, but in the last week or so, there have been attacks on shipping in the Gulf of Oman, and there have been attacks on Saudi oil facilities, and the Iranians shot down a U.S. drone. And all of a sudden, actually, it has been all of a sudden. It's only been in the last week, the oil market began to notice that, hey, we've come off by $17. We're at $50, which is the lowest it had been since late last year, since December. And maybe there's an impetus, or there clearly was an impetus to cover short positions and go long, which is not surprising, I think, given given what's transpired and what may transpire, which at this point is uncertain. But anytime there's a chance for military action in the Persian Gulf, that could be serious. Now, I have to say that I've been covering the Strait of Hormuz for, I'd say, 40 years now. We've been talking about it since September 22nd, 1980, when the Iran-Iraq War began. And, it every now and then, or cyclically, I think it comes into play, obviously, with the geopolitical developments. The Strait of Hormuz is what the U.S. government calls a choke point, through which 21 million barrels a day of petroleum liquids flow through, as well as a quarter of the world's liquid natural gas flows through. Now, can the Strait of Hormuz be closed? No. That's unlikely, and I think when we talk about the Strait of Hormuz being closed, it's really more of it's really not the Strait is going to be Hormuz, but the Strait is going to be closed. But it could be that there's going to be some wider or some other types of military action that we saw in the Gulf of Oman. Back during the Iran-Iraq War in the 1980s, there was a tanker war where both Iran and Iraq attacked shipping in either the Gulf of Oman or in the Strait of Hormuz. The U.S. Navy eventually formed convoys to bring to accompany the ships through the straits. And we did lose. There were barrels lost, but I think you have to look at, obviously, in the Persian Gulf, and you just have to look at a map, and you'll see Saudi Arabia, the UAE, Oman. Yemen is not is no longer a big producer, but clearly there's a potential for something to happen and to widen this conflict. And the market obviously has, as I said before, is reacting as well it should. However, what's also important besides the potential for a widening conflict here is that the fundamentals, in my opinion, were not quite as bad as say a $50 WTI. In fact, as we move ahead and look at third quarter, the fundamentals are actually look much better. We should be as we move into 3Q and looking at demand for OPEC crude and where OPEC is producing. It looks like there's going to be a shortfall. Now, it looked like there was going to be a shortfall in second quarter, but what happened is U.S. runs were much lower than had been anticipated, and as a result, U.S. inventories grew, crude inventories grew significantly in the second quarter. Total inventories have grown by about 0.85 million barrels a day during the second quarter. Let's say 1 million barrels a day in the second quarter. So as a result, we thought the build would be about half that, owing to lower runs and some softer demand numbers coming in. And as a result, inventories have built. The other part, there's also been a big build in natural gas liquids owing to the record production of natural gas. So we saw this build in the U.S., globally probably less so, but that clearly was one of the other bearish factors in the market coming off, as well as the trade war and fear about demand being hit in second quarter, third quarter, and into fourth quarter. But I think the market got way ahead of itself, because demand being hit, we're talking about growth of most of the analysts and most of the consultants were looking for growth, say 1.2, 1.3 million barrels a day this year. That's around where we were, 1.3. We have curbed that to 1.1, 1.0 to 1.1, around 200,000 barrels a day, where everyone else has also cut their estimate by 200,000 barrels a day. Well, Saudi production is down from November by 500,000 barrels a day, and OPEC production continues to decline. So we're taking that 200,000 barrels a day and just magnifying it, or the market did, into a big move down. And given where the balances are, or looking for third quarter, it certainly, in my opinion, wasn't justified. However, there was also a massive long position that got liquidated, and not surprisingly, as this long position has finally been liquidated, WTI, for instance, has gone from like 15 to 1 long to shorts on the big spec. It's now like 3 to 1. It's actually below where the averages are right now. So not surprisingly, as this position is liquidated, of course, it's time for the market to rally. So I think it got overdone on the downside, and on the upside here, we obviously don't know what's going to happen in the Persian Gulf, but certainly there could be a lot more upside depending on what does happen. There's also an OPEC meeting coming up. The G20, which I know Ed is going to be talking about, is coming up. Trump's meeting with the Chinese leader. So as I said in the introduction, there's a lot of cross currents going on. Furthermore, last night there was a massive fire at the PES Girard Point, which is in Philadelphia, a massive fire at that refinery. That refinery is 330,000 barrels a day. So far that we don't know what the damage is, but from early reports, it looks pretty serious. Now, 330,000 barrels a day is 25% of Pad 1 refining capacity. So that could be a big blow, and also could change a lot of the balances. It would be good, obviously, for U.S. refiners not in Pad 1, and certainly good for European refiners if this refinery is down for any length of time, and it appears, just looking at the pictures, like it will be. And not surprisingly, gasoline has gone crazy. Gasoline rallied significantly overnight, as well it should have. So that is certainly something to watch that just happened overnight. So a conflagration here in the East Coast, and a possible conflagration in the Persian Gulf, and again, it just shows what trading oil is all about: geopolitical, infrastructure, the global macro, and I think it's why it makes oil so interesting and such a great commodity to have followed for all these years. Even talking about the Strait of Hormuz again 40 years later is is really something.
Andy, speaking of infrastructure, can I chime in at this point?
Sure.
The Houston Chronicle has been doing numerous articles on the number of infrastructure changes that are going to change the global balance in probably the next 24 months. There's 7 different projects to help take some of the tremendous U.S. crude production and get it ready for export. And Phillips 66 had a good explanation of how this is going to be done. They're going to build 2 offshore buoys, and it's called a single buoy mooring or a single point mooring, 27 miles east of Port Aransas, which is just south of us here in Houston. It'll be fed by 2 underwater 30-inch crude pipelines, and that terminal would be able to handle what the industry calls a VLCC, or very large crude carrier. And each one of these crude carriers is 250,000 deadweight ton and holds 2 million barrels. So think of 2 million barrels a day. We need a VLCC to offtake from one of those SBMs every day if we have 2 million barrels a day of exports. And then I said, well, how big is this ship? So I went on and I searched, thanks to Mr. Google, what's the biggest cruise ship out there? And it's the Royal Caribbean Symphony of the Seas. It's also about 225,000 deadweight tons, but it's a little more interesting. It carries 5,500 people, has 24 pools or water slides, and a version of Central Park, which is a little more interesting than a VLCC. But there's one of the Symphony of the Seas, and right now there's 70 new builds of VLCCs in shipyards around the world. So I think what's going to happen here, again, infrastructure and a little bit more of the global dynamic, you're going to see a big change by the middle of 2021.
And we need this infrastructure because U.S. production continues to grow, thankfully, and this just shows the shift. You talk about it just shows the shift in the global dynamics, and what we're able to do on what we're able to do with our production, our exports, and our policy, quote unquote policies. But it certainly has changed things. The U.S. becoming a net exporter, which it will by 2020, 2021, versus when we were a major importer. Okay, I think that's enough for oil for a bit. I'm going to turn it over to Ed Meir to talk metals.
Thanks, Andy. Before you go, I'm just curious, what is your take now as to where we go price-wise And what do you think will happen? I mean, I know it's hard to, get into all the president's head and what the Iranians are doing, but what do you think will play out if, for example, the States has a limited strike, just sort of hitting a radar installation with no casualties or something like that, something limited? What impact do you think that will have? Or has that been discounted?
I don't think it's been, I don't really, that may have been discounted, but let's look at the ramifications. Yeah, we could have a limited strike and then the Iranians ramp up action against the Saudis. The Saudis are already asking they need more protection for their oil facilities, or something happens into the UAE or Oman. So, obviously the market is unlikely to go down if we see more, if we see further action against the Saudis and things get heated up, and that's the risk, really, is that you draw other actors into what looked to be a limited, limited strike, and the next thing the Saudis are involved, or the other Persian Gulf producers. Obviously, Israel is in the neighborhood. So it's a very dangerous situation. The other thing I did not mention is insurance rates. Obviously, have spiked. What I think it's the highest. It's the highest in decades. I think I don't have the exact year, but insurance rates for voyages into the Persian Gulf have really spiked. So there's bound to be some dislocation.
All right. Well, thank you for that. I'll just say a few words, not too long, on our markets, the metals markets. The main highlight this week has been gold, which has gotten to a 6-year high. We're currently at just under $1,400 an ounce. And, for months, it was, watching gold was like watching paint dry. It was just not doing anything except just flatlining pretty much in a within $150 range for the past 2.5 years. But we finally broke out of that range in just 24 hours, which was quite remarkable. And of course, the reason is partly the tensions in the Gulf, but more importantly has been this wave of global easing by the central banks. Led by the Fed, of course, this past week, and also just prior to the Fed meeting, the ECB saying that it's going to be, looking at further easing if warranted, and the Bank of Japan saying the same thing. In addition, you had 3 or 4 other central banks all lowering their rates this past month. So really, you're seeing an across-the-board move towards easier money, and that's what's really been driving the gold market. Interesting, on the European credit markets, there's a chart which we'll put in our research. Practically all the European bond markets are now negative, except for the UK and the US. The US isn't in Europe, obviously, but if you look at the global picture, most of the bond markets across the world, mainly in Europe and in Japan, are negative, except for little pockets of the 15-year and the 30-year. So it's quite a conundrum the ECB and other central banks have when they literally cannot move rates any lower, and in fact they'll go into negative territory as they have. So the question is, are we going that same path? Are we going to, in the event of a really serious slump here in the US, which I don't think we'll get, but you never know, are we heading towards zero or negative as well? Other than that, base metals have not been doing very much. They've been obviously moving higher with everything else, but they've been a relative laggard and are in fact down today because of a variety of reasons. Mainly, the Chinese macro numbers, again, have been pretty disappointing. We got weak PMI numbers as well this week. But I think the focus for the base metals is on the G20 summit later this weekend. The talk is that, the consensus view is that President Trump and Xi will agree to resume the negotiations. That, I think, is a reasonable scenario. I don't think either of them will walk out of the meeting or anything like that in a huff. I think they'll agree to restart the talks, but I don't think we will get a really effective agreement from all this, because the issues are so complicated that I don't think you can put it in an accord, let alone enforce it. So I think that's a problem the US and the Chinese face as they proceed down this very, very complicated situation. But at least Mexico is out of the way. We had a brief scare with the Mexican tariffs that came and went. NAFTA Part 2 seems to be getting ratified. The Mexicans put it through. The Canadians are going to put it through shortly. And I think there is some appetite here in the US to also get it passed. So at least that part of it is looking good. The key thing now is, settling things with the Chinese. And if the markets get a sense that there is some progress there, we could see the base metals rally a little bit going into the week after next. That's it for me. If any of you guys have any comments or additions.
Ed, I have a question.
Sure.
How much? Let's talk about price on gold.
Yeah.
How much more upside do you think there is here?
That's a good question. I'm looking at the charts now. I think we could, again, it depends on how things develop in the Persian Gulf. From my experience, these geopolitical events kind of have a one-shot impact. If they don't get worse, a rally tends to usually fizzle. So gold likes to see continuous upheaval for it to move higher. So we with that caveat, I think 1450 looks to be a good chart point. Some people were saying 1500 this week. But the key thing is technically the charts look really bullish. You have a lot of ETF buying coming in. I think it's been the most in 6 months. The breakout is clearly evident. So we may be pausing here, and in the event of another skirmish or retaliation by the U.S., I think we could probably move up another $50 to $100 over the short term.
Okay, it's a good move.
Yeah. Well, finally.
Yeah.
It's been really, really very. Keep in mind, we were at 1800 6 years ago, so we still have a lot of ground to cover. So but you kind of get complacent because it's been such a relatively tight range that throwing a number like 1500 seems huge, but it certainly is doable.
Okay, thanks, Ed. Marty, anything else?
No, that was really helpful, Ed. I kind of wondered what was going to happen to gold with all the geopolitical unrest, since normally it's been tied to financial markets. Now it seems like it's got two things pushing it up.
Yes.
Okay, so I think we'll wrap it up there. Thanks very much, Marty and Ed, for joining us. This is Andy Lebow from Commodity Research Group. You can reach us on the web at commodityresearchgroup.com, and my email is alebow@commodityresearchgroup.com. Marty?
Thanks for the opportunity to participate. If some of our trading listeners would like to learn more about the infrastructure relationships, take a look at our website and our 10-part mobile-ready series called Oil 101, talking about a lot the way the upstream, midstream, and downstream are interrelated. You can find us at www.ektinteractive.com. And again, thanks, Andy and Ed, for the opportunity to participate.
Thank you.